Welcome to a new episode of the Opening Bid Unfiltered podcast here at the NASDAQ in Times Square. I'm Yahoo Finance Executive Editor Brian Sozzi, and like I always say, this podcast will make you a smarter investor, period, and your IQ is going up after this one. I want to welcome friend of the show, Gargi Chaudhuri, Chief Investment and Portfolio Strategist at the Americas at BlackRock. Did I get that right? I always mess it up.
You did.
All right, there we go.
You.
So Gargi, good to see you as always. You're out with your recent outlook, and I'm trying to figure out how much more attention we need to start paying attention to the bond market. Nobody wants to pay attention to the bond market, but gosh, is it important, and especially now.
First of all, this is amazing. Thank you for having me here, and happy September. So to your point, we did just come out with our outlook, our fall investment directions, and we start off with just laying out how much things have changed, and especially to your question with respect to the bond market. I think it's really important to recognize that in the post-pandemic period, so the last, call it 5 years, how much the correlations between stocks and bonds have turned less reliable, so a little bit more positive, especially when you consider that a lot of the shifts have come from volatility picking up significantly in a 60-40 portfolio, and that has come from bonds, with bonds being more volatile than they were in the pre-pandemic regime. So you should absolutely be paying attention to the bond market, especially the very long end of the bond market, which may not be the traditional diversifier that it was, the 2 decades before 2020. And in addition to that, another thing that we're spending a lot of time thinking and talking about is, while that's the case, there's also immense opportunity in the front end and the belly of the curve. Given interest rate levels right now, given the availability of income, getting that 6% in fixed income, in quality fixed income markets hasn't existed in a while. So both exist. Higher volatility in the long end, incredible income in the belly.
You know what amazes me, Gargi, is that where the market goes long, stocks seemingly go up every single day, then poof, now we're focused on the bond market again. From your vantage point, what are people concerned about? That they can go from one day not paying attention to the bond market, and now they're looking at it every single day. I hear concerns about debt, inflation, but what's their biggest concern, I guess?
As someone who grew up trading bonds, I think you should look at it every day, anywhere. Real rates drive everything else.
You heard that? We heard you. You're down fired. Check these bonds. I mean, come on, can't ignore it.
You have to look at bond yields and real rates on bonds every single day, even though obviously I understand that stocks are a lot more exciting, a lot more sexy, but bond markets and sort of the real rate of bonds is actually driving your discount rate of your future cash flows for stocks. So very important. And then coming to your question more specifically on what might have been some of the drivers of the volatility, the recent volatility in the long end, the first one, of course, is inflation, right? It's not a new story, but obviously the last 5 years, you've had that inflation volatility declining meaningfully now, but still remaining sticky above that 2% level. And if anything, might poise a little bit higher by the end of this year instead of lower. So that's certainly something that's driving expectations of yields, especially in the very long end of the curve. The second one is just around deficits. You make this point. Rising deficits, not new. We've been talking about it for 30 to 50 years
right, for as long as we've been on this planet.
Yes, exactly. Since I've been in the markets, and probably even earlier than that, we've talked about deficits. That doesn't affect the markets every day, but certainly when you see auctions not going as well, or you see a breakdown of a long-end treasury auction and you see that much of the buyers are actually not end investors, they're not asset managers, they're actually lying with the street to redistribute, I think that tends to bring about some concerns. So there's certainly deficit concerns. There's also, right now, especially with the Fed poised to cut rates, we think that they will cut rates this year. We expect them to still be able to go twice this year, so a total of 50 basis points. But that's not actually driving the very long end. So that's moving the front end, that's priced in. But the long end is a different animal, right? So the long end not driven by what the Fed does, very much driven on expectations of growth and inflation and concern around deficits. So really thinking about what your listeners, what your investors want is they want to be compensated more for holding a riskier asset for a longer period of time. And they're not getting that. They will. The yield curve, as we say, is steepening. Long end yields are rising, more than the very front end. We think that's very natural, should happen at this point in the cycle, but it needs to happen even more. So pay attention to what's happening in the very long end of the curve, certainly driven by other factors, and the belly of the curve, or sort of the 3 to 7 year part of the curve, especially when you look at sort of owning securitized assets, owning corporate credit, owning international bonds hedged back into US dollar, creating that opportunity to give you about 6.5% yield. And we talk a lot in our research about our BlackRock income fund that is able to do that for you in an active ETF.
You mentioned rate cuts. Do you view rate cuts as gasoline to the stock market? In that it could send stock prices higher, or all these rate cuts are priced in already?
So a lot of the rate cuts obviously are priced in, but if you look at historically what happens during rate cutting cycles, especially ones that are not accompanied by a recession, you do have continued outperformance in equity markets, right? So there's a lot of focus on all-time highs. The stock market has made many of those as we sit here in early September. And we continue to believe that if the Fed is cutting rates in a time where we don't expect a recession, they're cutting rates to bring rates closer to what they believe to be the neutral rate, to make them less restrictive. And at the same time, growth is hanging in okay. And in fact, by some measures, especially when we saw the Q2 GDP revisions, we actually saw some significant impact of AI on GDP. And if that continues, I would say that that can be an absolute fuel to the stock market. But again, where you own stocks matters. We talk a lot about owning some of that large cap, growthier parts of the market where earnings growth has been very prevalent and is expected to continue to be so in the months ahead.
When you talk to clients, how concerned are they really about Fed independence, or is this a talking point?
Honestly, it hasn't really come up as much as you would have thought from US investors. And I want to separate different buckets of investors. Obviously, my role is more America, so I'm speaking to investors in LATAM, in Canada, as well as in the United States. I do think it's a talking point that comes outside of the US. And I think that the concern there is, how will the bond market respond to any perceived lack of Fed independence? And what we're telling clients there is the market will speak. So far, we haven't seen that at all. The yield curve has steepened, but there are many reasons for the yield curves to steepen, including inflation expectations and concerns for deficit. What hasn't happened is massive widening in inflation break-evens. You haven't really seen that. And I think that if there was a true Fed independence concern in the markets, you would certainly see that impact inflation break-evens in the front end as well as the long end of the curve. You'd see a massive spike in long end yields led by the long end. You'd see some concern in equities as well. Frankly, we haven't seen any of that. And I think that hopefully there's many other fundamentals that investors are thinking about, such as the incredible growth, such as the softening labor market, but yet not falling off a cliff, and such as earnings growth, especially in the tech part of the market, remaining so robust.
How concerned are you about the other side of cutting interest rates? It's often said Fed cuts rates, stocks go up, life is great. But do you think they would sow the seeds of inflation? If we're having this conversation in the middle of 2026, what do 3 rate cuts do to inflation?
So, we have to see what else. Obviously the rate cut for September and maybe one in December is more or less baked in at this moment. I think we'd really have to see if we're at this point expecting a continuing rate cutting cycle. So not just these 2, but 4 more next year at a time when inflation is going from sort of 3.1 to 3.3 or 3.5. If tariffs aren't, as to use a very unloved word, transitory as many expect, if that's actually something more meaningful, if services inflation comes back to the market, it's not just goods, but it's services, and on top of that, you have the Fed cutting rates, I think that's a real concern for markets. And again, this is why we talk a little bit about owning inflation protection, owning a lot of global market equity neutral strategies that enable you to have returns as well as really good Sharpe ratio in your trades at a time when we might face some inflationary pressures. But if it's just a Fed that's gradually bringing rates back to what they consider neutral at a time when inflation, when tariff-related inflation is more temporary in nature, I think that should be okay. But I also want to caveat, I know that historically, a lot of people have asked me, clients have asked about this as well. September tends to be a seasonally weak period for the markets. And so far, there's no reason to believe that this will be that. Again, earnings look strong, data in the markets look good, but at the same time, I do want to highlight that sometimes markets can have a self-fulfilling prophecy. So you expect it to be, you see some wobbles in the market, you sell. I just caution against doing that if the underlying data is still solid. So recognizing seasonally weak period for equities as well as bonds in September and early October, recognizing that in fact, if anything, provides an opportunity for some of the incredible amounts, 8 trillion or so of cash that's waiting to be deployed to come back to the market. And we're beginning to see that as well.
I'm hoping for a good September.
Well, we hope so.
Yeah. Hang with us, Gargi. We're going to go off for a quick break. We'll be right back on Opening Bid Unfiltered. All right, welcome back to Opening Bid Unfiltered here at the NASDAQ in Times Square. Having a great chat with Gargi Chaudhuri from BlackRock. You were the first person that has come on this podcast and said AI is starting to impact the labor market. Unpack that for us.
Impact growth was what, impact growth. So when we saw, well, actually both. Let's talk about each. So when we talk about growth, we just recently got the revisions to the Q2 GDP. And when you look at that revision and you see where some of that upward revision came from, one of the categories is around the intellectual property, the IPP, intellectual property product, which really looks at some of the CapEx spending, especially in software and the R&D that has gone into it. And that number was running somewhere around 4.6%, and that just got revised up to 12.8% for 2025 annualized.
Okay.
If that continues,
if you're not reading data like Gargi is doing, you need to read these reports. I mean, this is like really high-end analysis here. Go ahead. I had to give you a shout out. Please, go ahead.
Thank you.
Go ahead.
I do think that, if you think about what everyone was excited about in terms of AI, I wrote this internal note and I called it the summer AI turned pretty. Everyone, and if you're not watching that show, please do, everyone would focus more on NVIDIA earnings, et cetera. But I think the manifestation of AI into CapEx and it's showing up in your IPP in the GDP data is the real story here. And to the extent that, as our report points out, that we expect that by 2030, we've seen about 320 billion or so in AI investments so far. That number around data centers, land, power, utilities, et cetera, can be as high as 5 trillion. And this is something that is from a report from McKinsey that we quote. That can have significant impact on growth via some of these, via some of the IPP measures that I'm talking about. So certainly important to keep an eye on. The market continues to focus on is AI CapEx plateauing. At some point, maybe we will. We haven't seen that yet, but I think what the real focus should be is to what extent is the AI CapEx making its way into earnings, and to what extent is it making its way into growth data? And I'm really excited to see that we're beginning to see that. On the labor market point, look, I haven't necessarily seen a huge impact to that. There's so many dynamics going on in the labor market right now. We're obviously seeing just a cyclical softening. We're way into this cycle. So to expect the labor market to slow down is very fair at this point in the cycle.
The agent hasn't taken my job yet. I'm still here, Gargi.
You're still here. I'm still here. There's also the impact of immigration. So there's a demand side as well as a supply side. And Chair Powell obviously calls it this peculiar phenomenon that's taking place. There's certainly at some point there will be some job losses related to AI. I imagine that most of us are using AI for a lot of our work. and I think that'll feed into the data. But I think we should all focus on what are the positives as well. To what extent is it productivity enhancing? To what extent is it growth enhancing as a result of that? And then what we will start focusing on is that growth enhancement is going to make its way across all sectors of the economy, not just the semiconductor stocks.
Is AI then pro-growth? I look at AI, how it is starting to take some back office jobs, for example, but by the same token, you have companies investing billions of dollars to build out servers to support AI initiatives. Aren't they competing? Do they cancel each other out?
I think there are companies that are going to continue to do that. Right now, if you're a CEO of any company and you're not using AI, you're likely to sort of face your board and question your, question how you're running a business. So I do think the wave of AI investment is going to continue. It's just begun. So I think there is that impact of growth there. Now, the question that often clients ask is around the disinflationary or deflationary impacts of that. We haven't begun to see that yet. Eventually, we're looking at 2 or 3 years. Can that have a disinflationary impact? I think that's possibly the case. Again, how much does that get offset by inflationary impacts coming from just the economy growing at a faster pace? I don't know. But to be clear, this is going to be, there are going to be winners and losers in the AI story. So right now we've focused on the winners, but there are going to be companies that are not, or sectors or industries that are not going to be as fast or as quick to be able to adapt, that will lose out. And I think that's why sort of being a lot more active around the AI theme is something that we're talking about. Even if you look at Mag 7, I mean, that was the huge theme from 21 onwards, but even this year, even within those 7 names, you've had such a large dispersion. So that active management within AI is going to be more and more relevant in the months to come.
I think a lot of folks listening to this, and no offense to any of them, if they own 10 stocks, 9 of these stocks are very AI related. AMD, NVIDIA, they own all these names. Is that still okay to have an outsized portion of your portfolio to AI stocks like that, even though in some case they're trading at record valuations? I just hear what you're saying in terms of CapEx growth, and it gets me excited in thinking maybe these stocks aren't overvalued.
So it's exactly right. I mean, if you own, hopefully you own more than just 5 stocks, and if you do own 5 stocks, you own the best ones. But we're telling investors to sort of look at broader indices. We're recommending the BlackRock AI and Tech Fund BAI. Again, having that ability to go and pick AI names or up and down the capital stack that can participate in the CapEx and the growth of CapEx in the months and years to come. I think that, to your point around valuations, what's interesting is that if you look at tech as a sector or growth as a factor, if you look at the returns year till date, much of the returns have actually come from earnings. It hasn't come from valuations, right? So earnings expansion, expectations of earnings growth continuing. Even if you look at Q2 earnings season, if you look at tech at over 25% earnings growth, whereas non-tech was only about 6%, that is meaningful. And when you look at the revisions of Q3, massive revisions on margin as well as overall earnings for tech and consumer services. So I think that's going to make its way into continued outperformance. I like to say that some of these AI names driving the index is a feature. It's not a bug. It's really like, as we expect the earnings growth of these large cap companies to continue to grow, obviously they're going to be a larger and larger part of the index. And I think we continue to, again, actively think about the AI theme as one that's going to continue. Can it have pullbacks? Absolutely. Look, this is what people own, as you said.
Not everything goes up every single day.
It doesn't go up every single day. September, as we mentioned earlier, seasonally weak. Can there be periods where there's massive pullbacks? People sell what they own. Yes. But I think what we've seen, and this is the month where iShares just hit 5 trillion, and I bring this up because we're continuing to find investors moving to different parts of the equity market using iShares ETFs to take advantage of these dips. They're not necessarily leaving the market. They are continuing to flock to the market with risk on products such as equity ETFs related to growth and AI.
You've been writing a lot, and early, I should say, on digital assets. How much are digital assets, like whether it's a Bitcoin or other crypto type offerings, stable coins, how much are they competing for investment dollars amongst clients at BlackRock?
Yeah, so one of the charts that we have on our outlook is sort of looking at the, 2020 and 2015 and 2025 in terms of what percent of flows went to stocks, bonds versus alternative assets. And alternative here includes digital assets, also includes things like gold. Obviously, it was it was about 70-30 back in 2015. In 2020, you had about maybe a 2% allocation, which was funded from both stocks and bonds. And what we've seen in 2025, and obviously the year isn't over yet, but just even in the first 8 months of the year, is a significant allocation, about 20% allocation of flows to alternative assets. And we run these client calls every week where we poll our clients across the Americas that are joining, and we ask them, where are you looking to allocate in the months and years to come? And most of them are choosing diversifiers like gold, like liquid alternatives, and like digital assets as a way to have something in their portfolio that has different types of behavior, different characteristics. So lower correlation perhaps, or lower volatility, or maybe the same amount of volatility or higher volatility, but a much higher return premium. So the flow is there for commodities, both IBIT, which is our Bitcoin ETF, as well as IAU, which is our gold ETF. Massive inflows this year. And I think that's something that's probably going to continue as a source of diversifying in a 60-40, in a traditional 60-40 portfolio.
Is crypto viewed as safe?
It's certainly viewed as a risky asset.
Sense of change.
Yeah, it's
like
certainly
year.
viewed as a risky asset. No one is moving, or no one that we speak to or portfolios that we analyze is moving out of cash into crypto. So it's certainly not viewed as your cash-like safe asset. Let's be clear. It is viewed as an asset, however, that if you are an investor that's looking for a diversifier to your US dollar risk, if you are looking for that asset class that can give you, over longer periods of time, it can give you something that diversifies your US dollar risk, that can act as a little bit of a geopolitical risk, hedge, that is where IBIT and crypto is coming in. No one's viewing it as risk-free. One of the things that we're trying to do is educate around the volatility and the sizing in portfolios. So highly volatile asset class. And as a result of that, you have to be very thoughtful about where you want to fund from. So should it go from your cash allocation? Should it go from your equity allocation? We think it should go from your equity allocation, right?
So lessen how much stocks you hold and buy crypto.
And recognize that it's extremely volatile, but that it can add something in your portfolio, especially if you're looking for an asset class that can work as a diversifier to your US dollar risk, especially if you're looking for a geopolitical hedge, especially if you're looking for something that doesn't usually have a huge amount of correlation over longer periods of time. In the short term, it has very high correlation to equities, but in a very long period of time, doesn't have as much of a correlation to equities and bonds.
I suspect you have already started to think about 2026 in the markets. I mean, this year's almost over. I can't believe it.
Yeah.
What's on your radar for the first half of 2026?
Of course. So a couple of things. I think that thinking about, we've obviously at that point, we believe are going to have somewhat lower interest rates in the very front end of the curve than we have today. The Fed would have delivered one, certainly, maybe even two rate cuts. So one big thing on my radar, especially because in cutting cycles or in sort of cutting cycles, we've seen a lot of money move into cash. So investors looking and seeking ways in which they would step out of cash. So helping our clients think through how should, one of our ETFs, which looks at the very front end, it's sort of 1 to 3 month bills, is SGov. That's been one of the highest AUM generating, flow generating ETFs of the year. Investors are now saying, well, if rates are going to be lower in the next 6 months, where should I step out of cash into? So that's something that we're extremely focused on, educating clients that, if you were in cash because you expected to get 4.5%, 5%, that's not going to happen anymore. So where should you step out of cash into? Is it a fixed income asset that earns you maybe 5.5% to 6%? We think so. Or is it all the way out to Bitcoin, which may not be the case. So that's something we're absolutely focused on. The role of liquid alternatives in portfolio, I think that's going to be really important, especially as, we talked about this a little bit in the beginning, but these changing structural dynamics in the market where you are, a traditional 60-40 portfolio used to have a volatility of about 7%. That's now 70% higher at 12%. Investors want to do something about that because their bond portfolio is so much more volatile. Adding liquid alternatives, again, another way where you lower your beta, or lower your correlations to traditional public markets. That's something that I think is going to be very much in focus in 2026 because these dynamics that I'm talking about are still going to stay in place. And perhaps the last thing, this is more from a macro perspective, is we will have the answers, I think, or some of the answers to the question of were some of the impacts of tariffs inflationary or transitory or not?
The answers. We're going to get them anyway.
We're going to get them. We may not like them, but we're going to maybe by March or April of next year, about 1 year or so since some of the tariff news started hitting the markets, we're going to be able to see, was this more transitory in nature, was it not? And that then allows us to recognize, okay, so what does that mean about where the neutral rate is? How aggressive does the Fed need to be, if at all? Or do they actually need to maybe move rates higher? I don't think that's the case, but I think some of those questions are going to be really relevant, which again, to bring back to what we started with this show with, which brings fixed income very much on top of mind for investors.
How have I not given you all of my money to manage? Like I should have did this like years ago when I met you. I mean, holy cow. Before we let you go, hot take for you. How do you start your investing day?
So I run every morning. I'm training for the New York Marathon as well as the Florence Marathon. Ooh. So I run in the park every morning and I listen to sometimes your podcast, but some market-related podcast in the morning. When you're running, your brain is absorbing the most amount of information that it can.
How far are you running in the morning?
Like 5 miles. So it's perfect for a 45-ish minute podcast.
Hokas? Are you a Hoka fan? Or like Hoka?
No, I wear Brooks.
Me too.
Yeah, that is Hoka's, in fact, not a fan of at all.
Interesting. I just got into the Nike Alpha 3s, and I'm convinced I tore off 5 seconds from my time.
So racing, so those are your racing shoes then?
They're just like, they've turned into like my High Rocks training shoes. That's a different story. I've started to train for High Rocks. It's wild.
Okay,
it's wild.
So I'm a Brooks girl. I have worn them for the last 10 years, and they're the best for my long runs.
You're the best. We'll leave it there. Gargi Chaudhuri over at BlackRock. Always a treat to spend some time with you. You just kill it. I mean, you're the best. All right, we'll talk to you soon.
Thank you.
All right, that's it for the latest Opening Bid Unfiltered from the NASDAQ in Times Square. I know you got a lot smarter from this episode. If you want, just send me the check. No, I'm just kidding. Thanks for always tuning in. We appreciate it.